Hi everyone, my name's Gavin. I'm an investment advisor with Newport Asset Management, and I'm just going to spend about 15 to 20 minutes taking you through the soon to be launched Newport Diversified Income Fund. The usual disclaimer, this presentation is intended for sophisticated investors or wholesale clients, and nothing in the presentation should be deemed to be personal advice. Firstly, we'll just have a look at fund objectives. Then we'll have a look at some observations about markets and asset classes and strategies, observations that sort of underpin the philosophy and the rationale for why we've structured the fund the way we have. Then we'll dig a little deeper into fund strategy, and then we'll have a look at outcomes, and given time constraints, we'll probably end up leaving it there. So in terms of fund objectives, the strategy is an absolute return strategy. So it aims to produce positive returns that are unrelated to any single asset class or market. We'll have a multi-strategy objective. So we want to utilize a diversified portfolio of alternative assets and alternative strategies with an income focus. And we'll have a multi-manager objective. So we want to utilize a diversified portfolio of global investment managers that we think best fit those strategy selections. In terms of return objectives, we'll have an inflation plus 5% return objective, total return net of fees, and that return will be made up of income yield as well as capital growth. And in terms of risk, we'll have an objective around drawdown. We want to focus on minimizing the potential for deep and prolonged drawdown. We want to create a fund that has low correlation to relative return strategies, other multi-asset strategies, and other single asset classes, so that it's a good portfolio diversifier. And we also want to create a fund that has low volatility, so we want to achieve that benchmark return while minimizing price variability. So as David mentioned in his global macroeconomic update, central bank interest rates globally are at historic lows. And that puts us in a low rate environment for traditional fixed income assets. So what this diagram shows is some 10-year sovereign bond yields from around the world. Australia up in the top left, just below 1% per annum. This was back in July, but they haven't changed a great deal. United States on the bottom right there, well below 1% per annum. And some countries in Europe actually negative. And if we look at investment grade corporate bonds, we can see that the yield to maturity on the Australian 7 to 10 year index is currently around 2.6%, and the yield to maturity on the US 7 to 10 year index is around 1.83%. And the current dividend yield on the All Ordinaries index is also currently quite low by historic standards, down around 3%, which is well below average. Another observation that we would make is that traditional liquid asset class performance is highly variable and unpredictable. So if we look at something like Australian shares, back in 2007, they were a top performer, and for the following calendar year, they were very much a bottom performer. If we look at something like Australian bonds, they can go from being a top performer in 2011 to 2 years later being a bottom performer in this particular asset class set. So what that means is that the outcomes for portfolios that are built using these traditional liquid asset classes can also be uncertain and highly variable. So if you look at, say, the traditional 60-40 balanced portfolio, say 60% US equities, 40% US bonds, this chart shows the excess return over 3-month T-bills for every 10-year holding period since 1976. So every one of these squiggly lines represents a 10-year holding period. And we can see on the right-hand side that the range of outcomes for those 10-year holding periods is quite varied. And it ranges anywhere from minus 13% to about 155%. And the other thing we would point out is that for the most recent 3 10-year holding periods, the outcomes for those portfolios have come in at the upper end of that range. So what that suggests to us is that the 60-40 balanced portfolio just isn't really adding up like it used to. So what this diagram here shows is the return required on each side of the 60-40 portfolio in order to generate a 7% annual return. So if you were expecting, say, 5% per annum from the fixed income side of the portfolio, you would need 8.3% per annum from the equity side to generate that 7%. Now, one of the best predictors of long-term bond returns is purchase yield. So, for example, at January 2010, the yield on the Australian 10-year government bond was about 5.45%. And between January of 2010 and January of 2020, the Vanguard Australian Bond Fund returned 5.49%. So kind of in the ballpark. Now, the yield on the 10-year Australian government bond is currently 0.9% per annum. And research affiliates, their Asset Allocation Interactive, forecasts a 10-year nominal return for Australian government bonds of 1.2% per annum. So if we're up here in terms of the return from the 40% side of our 60-40 portfolio, we're going to be needing 10 to 11% per annum from equities in order to achieve a 7% per annum return. So not only does the data suggest that achieving 7% per annum from a simple 60-40 balanced portfolio or a portfolio of traditional asset classes going forward might be difficult, we would also make the observation that these types of portfolios are not very effective at managing drawdown risk. So what this chart here shows is the performance of 3 equity and bond portfolios in Aussie dollars this time, so Aussie equities and Aussie bonds. And you can see, looking at the blue line, the balanced portfolio went through, during the GFC, a near 30% drawdown. Now, with drawdown, inevitably comes recovery. So if we look at again, the balanced portfolio, the blue line, that portfolio took, where's my pen? Took about 4.5 years to recover from that drawdown and required about nearly a 40% return just to get back to where that portfolio was pre-GFC. So that just shows how drawdowns can be quite toxic to the sustainable compounding of capital over time. Here we've got some charts showing the performance of some traditional yield generating asset classes during the first quarter of this year, during the COVID crisis in March. So on the top left, we've got the MSCI Australia High Dividend Yield Index, and you can see that that went through a fairly significant drawdown towards the end of the quarter. Top right, we have the ASX 200A REIT sector, and you can see a similar drawdown towards the end of the quarter. Nearly a 40, that's around 40%. Bottom left, we've got some investment grade corporate bond ETFs. The domestic one didn't go through as much of a drawdown as the international corporate bond ETF did, but both staged a little bit of a recovery late in the quarter. And on the bottom right, we've got the Bloomberg Ausbond Treasury Index, which did go through a little bit of a sell-off during March, but did recover late in the quarter to finish the quarter positive. So you can see that those traditional yield generating asset classes, those liquid asset classes, can go through some periods of quite significant drawdown and volatility. Some alternative asset classes and less liquid strategies, on the other hand, can display some uncorrelated returns. So we've got some charts here. Top left is the ACS, so the Australian Core Strategies Direct Property Fund sector. So although it did go through a little bit of a drawdown in March, that was nowhere near, that's only 0.5%, so nowhere near the drawdown that listed property securities went through. Top right is precious metals, gold. So it did go through a little bit of a sell-off during March, but then finished the quarter positive. Bottom left, 2 funds that are trade finance funds. So both of those trade finance funds carried on doing what they do throughout the quarter and was seemingly unaffected by what was happening around them. And on the bottom right are 2 private debt fund managers. And again, you can see that throughout that quarter, those funds, the unit price and the performance of those funds wasn't really affected by what was happening within markets. The final observation that we would make around risk is that when you're moving away from traditional liquid asset classes into alternative asset classes, alternative strategies, and less liquid strategies, there's a real risk of being overexposed to a manager that gets it wrong. And obviously that can be quite detrimental. So I've got a few charts here of 4 funds. I won't name and shame the funds because they're all funds that no longer exist. But the fund on the chart on the top left is the chart of a hedge fund that was promoted quite heavily across the Asia Pacific region that ultimately ended up being a feeder fund into Madoff's Ponzi scheme. That fund no longer exists for obvious reasons, to the detriment of all investors. The fund on the top right is a UK legal financing fund that's currently in liquidation. So that was a fund that's designed to pool investor capital and provide fixed interest loans to law firms, solicitors to finance cases. That fund turned out to be quite poorly managed in terms of the loans being written and loans being not used for their intended purposes, and there's also allegations of some fraud there. So the bottom left is a UK commercial property fund that got into strife during the GFC when all investors decided to head for the exits. And you can see what happened to that fund during that post GFC period. And the fund on the bottom right was an Australian credit hedge fund that had significant exposure to subprime mortgage debt in the US and collateralized debt obligations, and you can see what happened to that fund after it got in trouble and was ultimately wound up. The other point we would make here is that low volatility does not equal low risk. You can see that all of these funds had fairly stable return profiles prior to blowing up effectively. So that's one thing that we as investors and we as managers need to be wary of, is that low volatility and low price variability does not necessarily mean low risk. So just to quickly summarize those observations, monetary policy rates at historic lows, investment grade government and corporate bond yields at historic lows, dividend yield on Australian equities near historic lows. Traditional liquid asset classes can exhibit highly variable performance and are prone to deep drawdown and can be volatile. Outcomes from traditional asset allocation approaches are also highly variable and prone to drawdown and volatility. Low volatility does not equal low risk. Being overexposed to a single manager, particularly in alternative assets and strategies, can be detrimental. And volatility is more of a characteristic than a single measure of risk. Drawdown and complete loss of capital to us are more important. So with those observations in mind, let's now have a look at the strategy that we've developed for this fund that we think might potentially help alleviate some of those issues that we've outlined. So the foundation for the fund really rests on 4 pillars, if you like. The first is multi-strategy. We want to expand the opportunity set away from traditional asset classes and asset classes that are traditionally used for yield generation, and we want to look at alternative asset classes, alternative strategies, and diversify away single strategy risk. The second pillar is multi-manager. That really facilitates the multi-strategy approach. That allows us to select best of breed managers in the strategies that we want to gain exposure to. And it allows us to obviously diversify away single manager risk. And obviously manager selection and monitoring is done on behalf of the investors, and they don't have to do that themselves. The third is illiquidity premium. So liquidity is generally defined as the ability to realize assets or investments in a timely manner without really affecting price. And it's generally accepted that there's a premium that's gained for not being able to do that. So for locking your capital up for a little bit longer, having a longer holding period, and not really having access to liquidity. So we want to harness some of that illiquidity premium, and mix liquid assets and strategies with less liquid assets and strategies, and in doing so potentially increase portfolio returns. And the fourth is low correlation and drawdown. So we want to build a portfolio of assets that have and strategies and managers that have a low correlation amongst each other. We want to utilize assets and strategies that have a low tendency for deep drawdown, and we want to reduce potential for portfolio drawdown, obviously, and produce better risk-adjusted returns in doing so. So what will the fund's portfolio look like post-launch? There's some pie charts here just showing the allocation by strategy, allocation by asset class, and the currency exposure. So we'll be diversified across 5 different asset classes, 7 different strategies, 12 underlying funds at launch and be geographically diversified. Due to the nature of some of these asset classes and strategies, we won't be able to click our fingers and have the portfolio fully invested from day one. So there will be a bit of a portfolio build, but this is the initial sort of target allocations that we'll be working towards. And in terms of portfolio restrictions, we won't have any more than 35% in any one strategy, no more than 10% in any one underlying fund at purchase, and no more than 50% of the portfolio to have lengthier liquidity terms than our own. And I've added this slide in at the end because I thought it would be interesting to illustrate that we're really not alone in this approach. So on the left, we have Australia's Future Fund, our sovereign wealth fund, and the asset allocation as at 30 June. And you can see that they have some fairly significant allocations to alternative assets down here, only 6.8% in domestic equities. And on the right-hand side, we have Yale University's endowment fund, and it's a similar picture over there. Only 2.75% in domestic equities and significant allocations to absolute return, venture capital, and those kinds of alternative assets. So we like to think that that we're offering investors a little mini future fund for them to invest into. So in terms of outcomes, this is obviously the part of the presentation where we would talk about the performance of a particular strategy or fund that we have been running. Now, obviously, this fund is yet to be launched, so we're talking about simulated performance data here. We did the portfolio construction process in July, and effectively all we're doing here is just saying, well, if we had have held the managers that we kicked the portfolio off with in the allocations, the starting allocations, going back to 31st of December 2012 with an annual rebalance, what would the simulated performance have been? And that's how we've produced these performance figures. So the annualized return for that period for the fund is 7.91 net of some assumed fund running costs. About 5.5% of that is yield or income generated. CPI plus 5 was 7.82. That's the return for the Financial Express Absolute Return Fund sector, and that's the return for the Financial Express Diversified Credit Fund sector. And in terms of simulated outcomes around risk objectives, you can see that the annualized volatility of the portfolio over that period was quite low, similar to that of a diversified credit sector. And we've managed to maintain a fairly low drawdown figure, much lower than absolute return fund sector and diversified credit fund sector. So I'll leave it there. I've probably gone well over my allocated time limit. If you want any further information around fund structure, fund terms, those kinds of things, we're happy to follow up with information. Thanks for listening.